Hey guys, today we will talk about IAS8 accounting policies, changes in accounting estimates and errors. This standard is really important because we can make mistakes in the preparation of financial statement, and this standard establishes guidelines for selecting accounting policies and addressing the changes of those policies, and addressing the changes in accounting estimates and correcting errors. It sets the foundation for reliable financial reporting, ensuring consistency and transparency. IAS8 is an old standard and became effective from 1st January 2005 with subsequent amendments aimed at enhancing accounting practices. It applies to all entities that prepare financial statements in accordance with an IFRS. The primary objective of IAS8 is to prescribe the criteria for selecting accounting policies and to establish how to account for and disclose changes in accounting policies, changes in accounting estimates, and rectification of errors. Certain areas are excluded from IAS8 scope, specifically the tax effect related to the correction of prior period errors and retrospective adjustment for accounting policy changes, which fall under IAS 12 income tax. Understanding the framework of accounting policy and the process of making the changes is crucial in ensuring the accuracy and reliability of the financial statement. First, have a look on accounting policies. It is highly important to understand it. These are the principles, conventions, bases, rules, and practices applied in preparing and presenting financial statement. They guide decisions related to the recognition, measurement, and disclosure of the financial information, ensuring consistency, transparency across reporting period. Selection criteria for accounting policies. When there is an existing IFRS or interpretation, it must be followed. Simply apply it. For example, if you bought an inventory, IS2 has to be followed. This maintains uniformity in accounting practices and ensure that the information presented is relevant to user of financial statement. In the absence of a specific guidance, management should use judgment and is required to ensure that relevance and the reliability in financial reporting. Number 3. Apply consistently. Consistency in applying the accounting policies across period fosters comparability in financial statement. If the management are using their judgment due to absence of a specific guidance, then they must adhere to certain conditions and steps. At the first instance, they need to check the IFRS and interpretation dealing with a similar and related issue, and the definition, recognition criteria, and the measurement concept for asset, liability, income, and expenses in the conceptual framework. And if they are unable to find anything, management may also consider the most recent pronouncement of the other standard setting bodies. Changes to an accounting estimates are necessary when required by an IFRS or when a new policy offers more reliable information. These changes should enhance the clarity and relevance of the financial statement presented. A key aspect of the policy changes is to improve the understanding of financial position and performance. How to account for change? Change in accounting policy involves applying a new IFRS. In this case, follow the transitional provision. If such provisions do not exist, the policy must be applied retrospectively to ensure that the previous financial statement reflect the new policy consistently. For the purpose of this standard, earlier application of an IFRS is not a voluntary change in accounting policies. Please note that. What a retrospectively means? It means adjust the prior financial statement as if the new policy had always been in effect. If it is impractical to apply from the starting, either due to the indetermination of the period specific effect or the cumulative effect of the changes, apply it at the beginning of the earliest period for which the retrospective application is practicable. Even if it is not possible, then last option is to apply prospectively and recognize the changes from the current period forward without adjusting past figures. Some changes will not be considered as changes in accounting policies, like transaction, other events, condition that differ in substance from those previously reported. Then you can follow different policy. New accounting policy for a transaction or other event or the condition that did not occur previously or were immaterial. Revalue of the asset in accordance with IAS 16 is covered specifically by IAS 16, so we cannot apply changes retrospectively. As per this standard, we need to check the specific requirement by relevant standard. Similarly, in IAS 38, we will see the specific requirement of the relevant standard. So the crux is, if the other standard provides specific treatment for changes in accounting policy, we need to apply those standards, but make sure the changes result in the financial statement providing more reliable and relevant information to the user of financial statement as per this standard. The second topic is IAS 8 deals with is an accounting estimate. Earlier the IAS 8 did not define the accounting estimate. Later on, in February 2021, the board issued the definition of accounting estimates. It is a monetary amount subject to measurement uncertainty. Example: depreciation. What would be the life of an asset? Residual value of the asset after useful life. Loss, allowance for the expected credit losses, net realizable value of inventory, provision for warranty. All these are the example of the reasonable estimate, and it is an essential part for the preparation of the financial statement and does not undermine their reliability. You need to know that accounting estimate involve the use of the judgment or the assumption based on the latest available reliable information. Keep in mind, assumption based on the latest available reliable information, and these are the approximation used for the measurement uncertainty in financial data. Changes in estimate arises due to the changes in the circumstances, like there are more volatility in the market or there are outbreak of pandemic, new information available, or the revision of the existing data. And the last point, it does not relate to the prior period, because prior period we deal in the third section. The changes in the accounting estimate must be applied prospectively in the current reporting period. For example, percentage applied for the loss allowance for the credit losses in the current and future reporting period, and update the SSL liabilities or equity in the current year by adjusting the carrying amount. Please note, when it is difficult to distinguish a changes in an accounting policy from a changes in accounting estimate, the change is treated as a change in accounting estimates. Prior period error. Prior period error means omission or misstatement of prior period due to a failure to use or misuse of the reliable information. It means either the information was available at that time or could reasonably be expected to have been obtained, but they failed to use or they misused the information. And it includes the mathematical mistakes, mistakes in applying the accounting policy, misinterpretation of the facts, and frauds. The treatment of prior period errors depend on their materiality and the timing. Error can be corrected either in the current reporting period or prior reporting period. If the error is related to the current reporting period, then rectify it in the same reporting period before the financial statements are authorized for issue. If the error relates to prior period, we need to check the materiality level. If it is material, adjust comparative for the previous reporting period. Adjusting the prior period financial statement will provide an accurate representation of financial position and result. And if the error is before the previous reporting period, then restate the opening balances. On the other hand, if the error is not material, you can adjust the error in the current reporting period. Sometimes it is impracticable to determine either the period specific effect or the cumulative effect of the error. Then apply it in the beginning of the earliest period for which the retrospective restatement is practicable. If this is also not possible, do it prospectively. Here the materiality is the same which is defined in IAS 1, but in short we can say error which can influence users' decision based on the financial statement if their omission or misstatement could rationally affect the decision of primary user of financial statement. Correction of error are distinguished from changes in accounting estimates. Accounting estimates are the approximations that may need changing as the additional information becomes available. But the error are the wrong use or the failure to use or the misuse of the available information, accounting policies, miscalculation, wrong understanding of the fact, and fraud. That's enough for this video. Thank you for watching.